US dollar selling has been relentless since the end of June, with the dollar index on track to record its sharpest decline since June 2015. The US dollar is now heavily oversold, which increases the risk of a corrective rebound in the near term. However, we see no fundamental evidence for the tide to turn for the US dollar anytime soon. Things are likely to get even worse for the US dollar in the coming months. The dollar index is currently trading just above key technical support provided from the lows from recent years. A break below would further reinforce our conviction that the US dollar is now in a structural bear market, with further weakness likely to prove both deeper and more prolonged than widely assumed. There is still plenty of scope for further weakness as the US dollar still remains materially overvalued. Heightened political uncertainty in the US could begin to weigh more heavily on the US dollar in the coming months. The Trump administration's recent failure to pass healthcare reform has further highlighted that Congress remains in legislative gridlock. Understandably, market participants have already started to become nervous over the upcoming negotiations to pass next year's budget and the debt ceiling, which could prove fraught. US Treasury Secretary Steven Mnuchin has recently warned that the government needs to raise the debt ceiling by the end of September. While we believe this is likely to happen, nerves are likely to be frayed before a last-minute agreement is reached. President Trump's recent tweet that the government needs a good shutdown highlights the potential for disruption. In the run-up to the last two debt ceiling standoffs in 2011 and 2013, the US dollar index declined similarly by around 3.5%. We believe that the risks are tilted in favour of an even larger sell-off on this occasion. The developments could have an impact as well on the Fed's plans to continue normalising policy. Potential financial market disruption could delay the Fed's plans to begin shrinking their balance sheet, and also solidify market expectations that the Fed is unlikely to raise rates again until next year. The Fed is already contending with lower than expected inflation, and as a result is unlikely to ride to the rescue of the US dollar anytime soon. It leaves the US dollar vulnerable to further weakness, while other major central banks are moving closer to tightening policy. ECB President Mario Draghi is expected to set the stage for the withdrawal of loose policies at his much anticipated speech later this month at Jackson Hole. In these circumstances, US dollar weakness could even overshoot short-term fundamentals and lift the euro-dollar rate back above the 120 level.